Hey everyone, welcome back to Corporate Decoder. Today, J.W.S.U.F just filed their 10Q report for the quarter ending the 31st of March 2026. I'm seeing a developing financial situation that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is facing some serious questions about its future, and the numbers in this report really lay out why. Alright, let's dive into Jaws Mustang Acquisition Corporation's latest financial report. This is a company that is basically a shell company, a blank check company, meaning it was formed to acquire another business. The clock is ticking for them to find a business to buy, and this report shows how that search is going, or rather, how it is not going well. Looking at their balance sheet, which shows what the company owns and owes at a specific point in time, we see some key figures as of the 31st of March 2026. Their cash balance was about $428,000. That might sound like a decent amount, but keep in mind this company has liabilities like promissory notes and other debts. They have promissory notes to related parties totaling over $2.2 million. That is a significant amount of debt, especially for a company that has not yet completed its business combination. Then there are warrant liabilities which jump to $1,861,250. These are essentially potential future obligations tied to warrants the company has issued. All their liabilities add up to over $7.3 million. That is a lot of debt for a company that has no operating revenue. And the shareholders deficit, which is basically where the company's equity stands, is a negative $6.8 million. This means their liabilities outweigh their assets by a huge margin. Now let's look at their statement of operations for the 3 months ended the 31st of March 2026. They reported general and administrative expenses of about $108,000. This is typical for a company in this stage, managing its operations and looking for a deal. But here is the interesting part. They actually report a net income of $269,426 for this quarter. How is that possible if they have no revenue? It is mainly due to a big swing in the fair value of their warrant liabilities. This line item shows a positive change of $372,250. Essentially, the value of these warrants went down, which makes the company's financial picture look better on paper for this quarter, even though it does not reflect any actual business activity. The net income per share for the redeemable Class A ordinary shares is a positive 1 cent, and for the non-redeemable shares, it is also a positive 1 cent. Looking at the changes in their shareholders deficit for the 3 months ending the 31st of March 2026, their accumulated deficit, which is the total net losses over time, is a staggering $6,873,000. This shows the ongoing losses the company has incurred since its inception. This results in a total shareholders deficit of nearly $6.9 million. So on paper, they are doing better this quarter due to the warrant value change, but the overall accumulated losses are still significant. Let's check out the cash flows. For the 3 months ending the 31st of March 2026, they used $68,076 in operating activities. This makes sense because they are not generating revenue from operations. On the financing side, they brought in $435,771 from proceeds from promissory notes with related parties. This is how they are funding their operations and extending their search for a business combination. Under the notes, we find crucial details about their business. Here, the going concern section is really important. It means they are talking about whether the company can stay in business for at least 1 year from the date of the report. The company states that if they do not complete a business combination by the 4th of December 2026, they will have to liquidate. They admit that this situation raises substantial doubt about their ability to continue as a going concern. Essentially, they are saying they might run out of money if they don't find a deal soon. They've borrowed $500,000 under a working capital loan from related parties. This is the kind of funding they rely on to keep going. Looking at fair value measurements, specifically their warrant liabilities. As of the 31st of March 2026, the fair value of public warrant liabilities was $1,293,750. The private placement warrant liabilities were valued at $567,500. These are significant numbers, and the fact that they are recurring liabilities means their value is reassessed often, impacting their net income. In the notes on warrants, it is clear that the company has issued a lot of warrants. These are essentially options to buy company stock at a set price. There are specific conditions under which these warrants can be redeemed. For example, if the stock price hits $18, the company can call back the warrants. This shows the company's strategy to potentially force the exercise or redemption of these warrants, which can impact its financial structure. In the management's discussion section, they lay out their business strategy. They are upfront about expecting significant costs as they search for a business to acquire. This constant need for cash to fund the search and operational expenses is a major challenge for SPACs like this. This is a critical point. The company was notified by the Nice American that it was being delisted because it failed to find a business to acquire within the required timeframe. This is a huge red flag. It means their stock is no longer on a major exchange and is now quoted on the OTC Basic market, which usually means less liquidity and less investor interest. They highlight their net income for the quarter, but again, it is driven by a favorable change in warrant values, not by actual business operations. This part on liquidity and going concern confirms the big picture. Without a business combination, they will need more money, and there is no guarantee they will get it. The entire future of the company hinges on finding a deal before their December 2026 deadline. Finally, looking at the exhibits filed with this report, there is an amendment to their Articles of Association that basically extends their deadline to find a business combination multiple times. This shows they have been using every available extension to try and make a deal happen. So, what is my take on all of this? Jaws Mustang Acquisition Corporation is in a critical situation. The numbers show a company living on borrowed time and borrowed money, with its financial performance artificially boosted by the changing value of its warrants, not by any real business success. The delisting warning is a serious blow, indicating major challenges in finding and closing a business combination before their final deadline. The risk of liquidation is very real here. What I am actually looking for is a clear path to a business combination that makes fundamental business sense and doesn't just rely on market fluctuations for warrant values. Alright, that is my take. Stay decoded. If you found this breakdown valuable, please hit that like button and subscribe. You can also join our Discord community for more discussions linked in the description below.